Number 4. The cost of a home refinance. To refinance your home loan, you will need to find a lender. Finding the right lender is likely to be time well spent, as it can get you money back. The cost to refinance a mortgage can range from 2% to 6% of your loan amount, depending on several factors including the size of your loan, your lender, your location, your credit score, your available home equity, mortgage term, mortgage type. 5. The no-cost home refinance. While searching for mortgage lenders, you may have encountered the intriguing term no closing cost refinance mortgage, also known as a zero closing cost refinance. In this article, we'll explain the meaning of a no closing cost refinance mortgage and give you the tools to decide if it's right for you. But before explaining the purpose of a no closing cost mortgage, we first have to understand the concept of closing costs. Pros. The benefit of refinance no closing cost is that it can spare you a ton of money in upfront fees. A no closing cost mortgage makes some or all of those fees vanish upfront. Cons. The downside of a no closing cost refinance mortgage is that it doesn't actually save you from having to pay the fees. You'll still have to pay them off with added interest. The higher the closing fees and the longer your repayment term, the more you'll end up paying to the lender in the long run for a no closing cost mortgage. A no closing cost refinance mortgage is a bonus option offered by lenders that empowers you to customize your mortgage to suit your borrowing ability. As with all aspects of your loan, assess the numbers for yourself to decide whether the benefits of a no closing cost mortgage outweighs the costs. The takeaway. Before you refinance your home loan, consider how much you'll have to pay in closing costs and compare that with how much the refinance could save you over time. After you do that, if you decide to refinance, go and shop for the best refinance companies and choose the lender that fits your needs. 5 ways to invest in real estate. Investing in real estate is one of the most rewarding and wealth-building strategies. Here are 5 ways to invest in real estate. 1. Buy real estate investment trusts. 2. Use an online real estate crowdfunding platform. 3. Invest in rental properties. 4. Invest in fixing and flipping properties. 5. Become an Airbnb entrepreneur. 1. Buy real estate investment trusts. REITs. What is a REIT? REIT rhymes with sweet, stands for Real Estate Investment Trust, and its popularity is growing for investors who seek to expand their portfolio beyond publicly traded company stocks or mutual funds. REITs are companies that own, and often operate, income-producing real estate such as apartments, warehouses, self-storage facilities, malls, and hotels. Their appeal is simple. The most reliable REITs have a track record for paying large and growing dividends. Still, that potential for growth carries risks that vary depending on the type of REIT. REITs are required to meet certain standards set up by the IRS, including that they return a minimum of 90% of taxable income in the form of shareholder dividends each year. This is a big drawback for investor interest in REITs. Receive at least 75% of gross income from real estate, such as real property rents, interest on mortgages financing the real property, or from sale of real estate. Have a minimum of 100 shareholders after the first year of existence. Have no more than 50% of shares held by 5 or fewer individuals during the last half of the taxable year. Number 2. Use an online real estate crowdfunding investing platform. If you're familiar with companies such as Prosper and Lending Club, which connect borrowers to investors willing to lend them money for various personal needs, such as a wedding or home renovation, you'll understand online real estate investing. These platforms connect real estate developers to investors who want to finance projects, either through debt or equity. Investors hope to receive monthly or quarterly distributions in exchange for taking on a significant amount of risk and paying a fee to the platform. Like many real estate investments, these are speculative and illiquid. You can't easily unload them the way you can trade a stock. The rub is that you may need money to make money. Many of these platforms are open only to accredited investors defined by the Securities and Exchange Commission as people who've earned income of more than $200,000, $300,000 with a spouse in each of the last 2 years or have a net worth of $1 million or more, not including a primary residence. Alternatives for those who can't meet that requirement include Fundrise and Realty Mogul. Number 3. Think about investing in rental properties. Investing in rental property can be lucrative, but it can come with many challenges. When planning on owning rental properties, be ready for the challenges, but don't let them intimidate you. Know that there are solutions that can help you overcome them to start making money in rentals. Borrowers usually need to secure at least 20% down payment for a rental property mortgage. Being a landlord requires a broad array of skills, from understanding basic tenant law to fixing a leaky faucet. Experts recommend having a financial cushion in case you don't rent out the property or if the rental income doesn't cover the mortgage. Number 4. Consider flipping investment properties. You invest in an underpriced home in need of a little love, renovate it as inexpensively as possible, and then resell it for a profit. Called house flipping, the strategy is a wee bit harder than it looks on TV. There is a bigger element of risk because so much of the math behind flipping requires a very accurate estimate of how much repairs are going to cost, which is not an easy thing to do. You might consider finding an experienced partner. Maybe you have capital or time to contribute, but you find a contractor who is good at estimating expenses or managing the project. The other risk of flipping is that the longer you hold the property, the less money you make because you're having to pay a mortgage without bringing in any income. You can lower that risk by living in the house as you fix it up. This works as long as most of the updates are cosmetic and you don't mind a little dust. Number 5. Become an Airbnb entrepreneur and invest in short-term rentals. Finally, to dip the very edge of your toe into the real estate waters, you could rent part of your home via a site like Airbnb. It's house hacking for the commitment phobe. You don't have to take on a long-term tenant. Potential renters are at least somewhat pre-screened by Airbnb, and the company's host guarantee provides protection against damages. Renting out a room feels a lot more accessible than a fancy concept of real estate investing. If you've got a spare room, you can rent it. Like all investment decisions, the best real estate investments are the ones that best serve you, the investor. Think about how much time you have, how much capital you're willing to invest, and whether you want to be the one who deals with household issues when they inevitably come up. To conclude, if you don't have the do-it-yourself skills and you don't have a big capital, you need to consider investing in real estate through a REIT or a crowdfunding platform rather than directly in a property. Thank you for watching this video and stay tuned for more real estate educational materials. How to buy your first home. Buying a home is a big decision, and it can be a time-consuming process. It can take 1 to a couple of months to shop for a home, plus 14 to 60 days to close on a house once you're under contract. Learning how to buy a house might feel overwhelming, but Mr. Super Realtor is going to make the buying process easy by breaking it up into these 5 easy steps. 1. Figure out how much house you can afford. 2. Check out the first home buyers programs in your city. 3. Get pre-approved for a home loan. 4. Hire a real estate agent and an attorney. 5. Make an offer, get your keys, and everything in between. 1. Figure out how much house you can afford. Before you even start looking at homes online, figure out how much house you can comfortably afford with your current budget. Typically, the total value of your new home shouldn't be more than 3 to 5 times your total household income. If you have high debt and a tight budget, choosing a less expensive home so you can have a smaller mortgage payment could be a good idea. On the other hand, if you're debt-free and have fewer expenses, you might be able to splurge on a pricier home. When figuring out how much you can afford, be as accurate with your budget as you can. It will have a big impact on your calculations and pre-approval applications later on. 2. The first-time homebuyer programs. If you're a first-time homebuyer, you might be eligible for special mortgage programs like FHA loans. FHA loans are backed by the government and issued by the Federal Housing Administration, FHA. They also come with lower credit score and lower down payment. An FHA loan, your credit score can be as low as 580, and your down payment can be as small as 3.5% of the home's purchase price. If you're buying a home for $200,000, you will need only $7,000 for the down payment with an FHA loan. That's much less than the 20%, in this case $40,000, that's usually suggested for a down payment. 3. Get pre-approved for a home loan. Your next step is to get a mortgage pre-approval. When you're pre-approved, you'll get a letter from your lender saying you'll likely qualify for a mortgage up to a certain amount based on your current income and credit score. These letters are typically good for up to 3 months. 4. Hire a super realtor and an attorney. When it comes to choosing the right agent, nothing beats an old-fashioned word-of-mouth recommendation. Your friends and family will tell you things you won't find on an agent's website, like whether they were responsive to emails and texts, how proactive they were about recommending listings, and their general demeanor. Work with someone you can trust and who can make your process easier. A resourceful agent who knows his market and has a network of other professionals along the way. For the attorney, your realtor can recommend the attorney that will work with you if you haven't yet chose one. 5. Making offers and getting your keys and everything in between. Your agent is going to prepare your offers and send them to the sellers. He will advise you what to do to get your offer accepted. After that, the ball will go into your lender's field, who will appraise the property and send the loan to his underwriters to process the loan to get a commitment letter from the bank. After that, the closing attorney will send you the famous closing disclosure package. Before the closing, your agent is going to take you for the property walkthrough to see if the house is still in good shape. At the closing day, the closing attorney is going to send you the exact closing cost amount to get a certified check to the closing. You will sign the closing paperwork and get your keys. And voila! Thank you for watching, and if you have any questions or want me to simplify any real estate related topic, please write it in the comments.